first off, let's go to what we've been talking about with clients. Everybody's been asking, and you highlight in the quarterly letter, for the first time in basically a decade and a half, it actually pays to pay attention where your cash is.
Back when we were in Chicago in 2005 and 2006, you're opening up a checking account as a freshly minted Ohio State grad, and for me, a Mercyhurst College grad. And Bank of America, at least for me, was paying me 5% in my checking account, not savings, not in the CD, just 5%, just for having my cash there. It didn't matter if you had your money in a checking account, a savings account, a T-bill, a purchase money market account, a certificate of deposit. It just didn't matter, right? You're making the same amount of money. I do think when you sit down and you talk to clients, they don't want to talk about international, which we'll talk about a little later, being up, a little bit over 8% to start the quarter, or the strength of U.S. equities. They want to talk to you about cash. They want to talk to you about what do you think that they should do with cash.
Yep. I was looking at yields this morning before we jumped on this video, but I'm going to mention Schwab because we do business with Schwab, but Fidelity, Vanguard. Not trying to just talk about Schwab, but you can go buy a money market right now and confidently, north of 4.5%. Let alone if you go dip your toe on the short end of the U.S. Treasury curve, maybe go out 6 months, and I think I'm looking at 4.9%.
For the last 15 years, there was the acronym, right? TINA. There is no alternative, right, to stocks, because you did have all of these instruments were yielding nothing, right? They're yielding 0 or certainly less than 1%. So that there was the incentive to go out and earn more because you didn't have another option. Stocks being down 10% in a quarter used to happen all the time, and it's the reason that you get compensated, right? You earn more keeping your money in stocks over time because you have to withstand this volatility, right? That's the premium you get for pushing your money out on the risk curve. I think that a lot of investors, though, were conditioned, wow, this volatility thing, we don't, it's not real, right? The Fed will come in and save us, right? That infamous Fed put, the first sign of danger, the Fed's going to come in and cut rates or do something accommodative to get the economy back going. And the Fed is not doing that, right? They've been steadfast. They raised rates last meeting in March or in early April when a lot of people were clamoring in lieu of the bank failure of Silicon Valley Bank and Signature Bank in New York, that they shouldn't raise rates. But they kept raising them, right? Because they're really focused on inflation. And this higher rates for longer is going to create more volatility. At least that's our baseline assumption. And so if you're an investor that's not really used to volatility, 5% in the 6 month, 4.9% in a U.S. Treasury bill, that doesn't sound so bad.
Do we expect you to be able to earn, let's just say roughly 5% on a 6 month Treasury forever? No, but while the opportunity is there, to your point, I do think it makes the calculus between the risk premium in equities and clipping coupons at 4 to 5% a little bit more compelling. On a rolling 12-month basis here through 3/31/23, international markets have added comparatively to U.S. large cap and even small and mid cap value.
We had been, I think, steadfast in saying that there was diversification to be had in your portfolio and an opportunity, right, that international equities offered. And I think for us, when we looked at it, the valuations looked really good and really compelling in international, both developed and emerging, but they never re-rated. And I think that was frustrating for us because we kind of kept, we kept our allocation there, and it was underperforming. It was positive, right? But it was a drag on performance relative to large cap stocks, right? The dollar peaked at at a level of 112, right? So if 100 is kind of the par value of that index, it got up to 112, and then it just started to roll over. So it hit this peak of 112 in September, and then it really started to roll over. And in the fourth quarter of 2022, you saw international developed was up 17%, emerging markets were up 10, outperforming U.S. large, mid, small, right? The entire U.S. equity complex. You have really good valuations, and you have the dollar rolling over, which makes these international companies more competitive versus their U.S. peers. I think that combined with you're earning more on a dividend yield, right? The international stocks pay better dividend than their U.S. counterparts. And now you've got the start of investors saying, hey, this does look really good. And now there's a reason that it looks good.
Well, with that, let's bring it back to the U.S. Give us a little bit more there in terms of your observations and your takeaways in terms of, January, February to March. And again, I don't want to get too focused on one quarter's worth of returns, but a lot did happen.
Yeah, I think that, well, first, when you talk about the regional banks, so Silicon Valley Bank, obviously publicly traded, First Republic, publicly traded. A lot of these, smaller banks are either small or mid-cap stocks. So kind of by definition, right, they're going to weigh down. The regional bank index, I think, was down about 25% for the quarter. They're at this like kind of dual, the Fed is saying one thing and the market's saying the other, right? The market's saying, not only do we think that you're going to pause, but you're going to start to cut rates, and you're probably going to cut rates more aggressively than you think. And what that caused the market positioning to do is to go with, well, what did well when interest rates were low and where monetary policy was more accommodated? Large cap growth stocks. And what recovered really well? Large cap growth. What happened in March was, unprofitable tech, mega cap tech, it rallied because the market is saying the Fed's going to pivot.
Federal Reserve has a dual mandate, right? Price stability and full employment. Employment thus far appears to be in very good shape, maybe even stubbornly so, right? Unemployment still at 3.5%. So the price stability, right? So the inflation still running far above 2%, right? So that's the Federal Reserve's main focus. I'm not asking for a near-term call because, as you highlight, we're not near-term investors, but ultimately you frame the question, who do you believe?
The adage that prevailed the last 10 years was like, don't fight the Fed, right? And I think that goes to kind of there is no alternative that we talked about earlier, kind of this idea that you don't want to fight the Fed. I'm going to take the Fed at their word, and they're going to keep it higher for longer. To your point, I mean, we don't really, that's going to sort itself out. We don't have a crystal ball. And I just drew the analogy to what my father did when he was coaching us. And he would constantly be preaching if we were in a tight game. He would say, no peaks, no valleys. And then he would stick his arm out like this, right? And I think what he was trying to say to us was just, you can't be a prisoner of the moment, right? You can't be the highest of highs or the lowest of lows. You need to be even keeled. And we identify kind of three levers that you can pull on, right? This idea of no peaks, no valleys. The first one is diversification is your friend. You want to own stocks, bonds, real assets, which is something that we've been pounding the table on, for the better part of, 3-4 years that should be a part of your diversified portfolio. The second thing is what we opened up with. Make sure your cash is earning make sure your cash is earning a reasonable rate of return. And I think the third thing that's going to get you through this is, just making sure that you're up to speed on, what your goals and objectives are. Have they changed? Are you communicating that change to your advisor, right? It's this idea of this two-way relationship that really adds value. To your point earlier, which you kicked it off, there's going to be there's always something to talk about in these updates. I think you got to lean on those three things and get through it together, right? The relationships that you have with your advisors, I think that's what's going to help get you through these difficult times. Markets are up; they've recovered from a pretty difficult 2022. You've got 2 quarters now where most major equity indices were positive. It's a great time to do a little spring cleaning, if you will, and just check in and make sure that everything is where it needs to be. There's no right or wrong answer as a broad statement, right? Because each individual portfolio, each individual financial plan is unique.
I think that puts a wrap on this quarter's communication. Obviously, I think we've done a nice job, and we'll continue to put out content as things continue to evolve and try and provide the audience our opinion in real time. But obviously, please don't hesitate to reach out to us as well if you'd like to have a conversation.